Hi, I'm Dahlia, founder of Streetwise Mortgages. If you are in a variable rate mortgage product today, where the payment has been fixed and stable during the rising rates environment that we've been experiencing, then you need to pay a close attention to something called the trigger rate. While you will find the term trigger rate in the credit agreement you signed with your lender at the time you arranged the mortgage, most probably this credit agreement is sitting in a drawer or on a shelf somewhere collecting dust. Right now, this term trigger rate is coming into the spotlight for a reason. It's because we've just come out of historically low interest rates, and the Bank of Canada has been increasing the overnight rate, which drives prime rates at a very fast pace. In fact, a pace that is faster than anyone expected. What happens with variable rate products is that the payment stays fixed. And when the rates rise, the payment is protected. But the allocation of what goes towards interest versus principal beneath the surface changes until, and here is the key point, until that payment no longer covers the principal pay down. Let's take a look at an example. Let's say you took a $500,000 mortgage in January of 2022 at prime -1. Very, very nice discount. When prime at the time was at 2.45, your payment would have been $1,713 roughly. And about $600 of that payment would have gone towards paying down interest, and $1,100 roughly would have gone towards paying down principal. Then the Bank of Canada raised the overnight rates in March of 2022, and prime rose to 2.7 from 2.45, then to 3.7, then to 4.7, then to 5.45 as of September 2022. Let's take a look at what happens. What happens to the payment of $1,713? Well, it stayed the same, which was amazing for protecting your cash flow during these times. But looking beneath the surface, in July of 2022, when prime was at 4.7, the interest payment would have gone up to $1,541, and only $172 would have gone towards paying down the principal. Then in September 2022, prime went up again to 5.45, and again, the payment has stayed the same, but now $1,854 of that payment is going towards interest, and none is going towards paying down principal. So now we owe money to the bank, and that is your trigger point. The trigger point differs from one client to another, depending on when the client took their variable rate mortgage. If they have taken it at the lowest point, when prime rates were low in March 2020, the discount to prime that they've arranged with their bank, was it prime -1? Was it prime -50? Was it prime minus something else? And if they had made any payments towards principal above and beyond the fixed payment stated in the mortgage agreement. The best way to figure out your trigger point is to basically go back to the credit agreement. That number will be there for you, but to also keep an eye on your online mortgage statement to see how much of your payment is going towards principal currently versus interest. By now, you may have hit that point, especially in September, as the rates have increased further. And by now, you may have received notification from the bank. If not, you are paying, if you haven't received that notification from the bank, then and you are currently paying very little principal right now, then you will hit that point during the next rate increase that is scheduled for October the 26th. So what happens? What happens when you hit this trigger point? Well, the bank will ask you to do one of three things. Number one, make a lump sum payment against the loan amount to bring down the balance owing, or convert to a new fixed rate. I do not recommend taking anything above a 1 or a 2 years fixed term right now, because if you were to lock into a 5 years fixed, you are going to lock into a rate at the height of the cycle. Number three, increase the mortgage payment to pay off the outstanding principal balance within the remaining amortization of the original mortgage. So if you have not received a letter from the bank yet, be proactive. Reach out to your bank so you can plan ahead which option to consider. And if you want your payment going forward to adjust as the rates increase, so you can pay down the principal based on your original plans instead of having to come up with lump sums or lock into a fixed rate mortgage that you don't really want to lock into, or if this new payment, adjusted payment, is higher than what you can afford or would like it to be, then you may want to consider what's called an adjustable variable rate mortgage, because with such a product, your payment changes as the rates change. Myself and my team can help you explore that option. What happens if you choose to do nothing? If you choose to do nothing with this trigger rate and the payments continue to fall short for covering principal to the point where the outstanding interest and principal exceed the original principal amount, then something called the trigger point kicks in. And that is the point at which the bank would call you and recall the mortgage. Hopefully, no one would get to that point, because we are all informed investors. We are proactive, and we will make the right decision. If you have reached or close to reaching your trigger point, or you are in a variable rate product and you are concerned about the next Bank of Canada rate increase that is very likely to happen on October the 27th of 2022, myself and my team would be happy to help you explore your options and guide you through, given, of course, your financial situation, because every situation is different. Feel free to reach out to us at info@streetwisemortgages.com.